Hello, this is Samantha Shares. This episode provides a comprehensive summary with extensive direct quotes from the OX Comptroller's Handbook booklet, Model Risk Management, released as version 1.0, August 2021. Complex credit unions can improve operations via the principles discussed in the handbook. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of National Credit Union Administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in process NCUA examination, reach out to learn how they can assist at marktrikel.com. Also check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. And now the comprehensive summary with direct quotes. Introduction and Purpose. The Office of the Comptroller of the Currency's OCC Comptroller's Handbook booklet, Model Risk Management, is prepared for use by OCC examiners in connection with their examination and supervision of national banks, federal savings associations, and federal branches and agencies of foreign banking organizations. The booklet aligns with the principles laid out in the Supervisory Guidance on Model Risk Management conveyed by OCC Bulletin 2011-12. This booklet serves multiple purposes. It is designed to guide examiners in performing consistent, high-quality model risk management examinations. It presents the concepts and general principles of model risk management, and informs and educates examiners about sound model risk management practices that should be assessed during an examination. Additionally, it provides information needed to plan and coordinate examinations on model risk management, identify deficient practices, and conduct appropriate follow-up. Definition and background of models. The OCC provides a clear definition of what constitutes a model. For the purposes of this document, the term model refers to a quantitative method, system, or approach that applies statistical, economic, financial, or mathematical theories, techniques, and assumptions to process input data into quantitative estimates. A model consists of three components. 1. An information input component, which delivers assumptions and data to the model. 2. A processing component, which transforms inputs into estimates. 3. A reporting component, which translates the estimates into useful business information. The guidance acknowledges that models are simplified representations of real-world relationships among observed characteristics, values, and events, and that simplification is inevitable due to the inherent complexity of those relationships, but also intentional, to focus attention on particular aspects considered to be most important for a given model application. It's important to understand that models are never perfect, and their quality can be measured in many ways, including precision, accuracy, discriminatory power, robustness, stability, and reliability. The handbook emphasizes that, in all situations, it is important to understand a model's capabilities and limitations given its simplifications and assumptions. In contrast to models, the guidance notes that a quantitative tool not meeting the definition of a model described in the MRM Supervisory Guidance may apply deterministic rules or algorithms to process information and produce outcomes defined by the deterministic rules. The determination of whether a quantitative tool is considered a model is bank-specific, and a conclusion regarding the tool's categorization should be based on a consideration of all relevant information. Expanded use and importance of models. Banks now rely heavily on quantitative analysis and models in most aspects of financial decision-making and routinely use models for a broad range of activities. Examples of model uses include underwriting and managing credits, valuing trading exposures, pricing, risk hedging, managing client assets, measuring compliance with internally established limits, measuring compliance with laws and regulations including consumer protection-related laws and regulations, estimating the allowance for credit losses as CL and capital adequacy, issuing public disclosures, preventing and detecting fraud and money laundering. The expanded use of models reflects their benefits. Models can help increase automation, transparency, and consistency of bank activities. However, the handbook notes that with these benefits come costs. There is the direct cost of devoting resources to develop and implement models properly. There are also the potential indirect costs of relying on models, such as the possible adverse consequences including financial loss of decisions based on models that are incorrect or misused. The handbook points out that the expanded use of models combined with their increasing complexity and value in decision-making underscore the importance of sound model risk management. Technological advances and model complexity. The guidance acknowledges that technological and analytical advances are contributing to increased model complexity and use. It specifically mentions artificial intelligence (AI), which is broadly defined as the application of computational tools to address tasks traditionally requiring human analysis. Examples of AI uses in banks include fraud detection and prevention, marketing, chatbots, credit underwriting, credit and fair lending risk management, robo-advising, that is, an automated digital investment advisory service, trading algorithms and automation, financial marketing analysis, cybersecurity, Bank Secrecy Act/anti-money laundering BS/AML, suspicious activity monitoring and customer due diligence, robotic process automation, and audit and independent risk management. The handbook notes that some AI may meet the definition of a model, while other AI outputs are not always quantitative in nature. Regardless of how AI is classified, the associated risk management should be commensurate with the level of risk of the function that the AI supports. Risks associated with the use of models. The handbook identifies 8 categories of risk for bank supervision purposes: credit, interest rate, liquidity, price, operational, compliance, strategic, and reputation. It notes that model use can affect risk in all 8 categories of risk, and that the use of models can increase or decrease risk in each risk category depending on the model's purpose, use, and the effectiveness of any relevant model risk management. Model risk is defined as the potential for adverse consequences from decisions based on incorrect or misused model outputs and reports, which can lead to financial loss, poor business and strategic decision-making, or damage to a bank's reputation. The handbook explains that model risk occurs primarily for 2 reasons. 1. The model may have fundamental errors and may produce inaccurate outputs when viewed against the design objective and intended business uses. 2. The model may be used incorrectly or inappropriately. Even a fundamentally sound model producing accurate outputs consistent with the design objective of the model may exhibit high model risk if it is misapplied or misused. The guidance emphasizes that banks should identify the sources of risk and assess the magnitude, and that model risk increases with greater model complexity, higher uncertainty about inputs and assumptions, broader use, and larger potential impact. Strategic risk. Strategic risk is defined as the risk to current or projected financial condition and resilience arising from adverse business decisions, poor implementation of business decisions, or lack of responsiveness to changes in the banking industry and operating environment. The handbook notes that the board of directors and senior management are the key decision makers that drive the strategic direction of the bank and establish a governance framework for using models. Strategic risk increases when models and associated risk management do not keep pace with strategic changes, the capability of employees, the operating environment, and regulatory requirements. Operational risk. Operational risk is described as the risk to current or projected financial condition and resilience arising from inadequate or failed internal processes or systems, human errors or misconduct, or adverse external events. The guidance states that operational risk is the primary risk associated with the use of models and can result from fundamental errors in a model when viewed against the design objective and intended business uses without sufficient use of model overlays and adjustments when model limitations become apparent. Operational risk can also increase when personnel who do not have sufficient skills and training to develop, implement, use, and validate the bank's models. Reputation risk. Reputation risk is the risk to current or projected financial condition and resilience arising from negative public opinion. The handbook notes that inadequate policies and processes, operational breakdowns, or other weaknesses in any aspect of model risk management or governance can increase reputation risk. Specifically, A bank could incur reputation risk from biased data outcomes, data losses, noncompliance with regulations, fraud, downtime, and insufficient consumer protections. Compliance risk. Compliance risk is described as the risk to current or projected financial condition and resilience arising from violations of laws or regulations, or from nonconformance with prescribed practices, internal bank policies and procedures, or ethical standards. The handbook states that compliance risk is elevated when banks do not comply with model-related laws and regulations, and when models result in potential discrimination on a prohibited basis or other violations of consumer protection-related laws and regulations. It specifically mentions that a bank's fair lending compliance risk could increase when a bank's credit decisioning models include algorithms, variables, or other processes that result in disparate impact on credit applicants or customers based on prohibited factors, such as race, ethnicity, or sex. Credit risk. Credit risk is defined as the risk to current or projected financial condition and resilience arising from an obligor's failure to meet the terms of any contract with the bank or otherwise perform as agreed. The handbook notes that banks use models to increase efficiency in all stages of lending, and that if credit risk models do not incorporate underwriting changes in a timely manner, flawed and costly business decisions could occur. However, models that are well designed and effectively managed can help management make prudent risk selection and monitor and manage credit risk. Liquidity risk. Liquidity risk is the risk to current or projected financial condition and resilience arising from an inability to meet obligations when they come due. The handbook states that liquidity risk can increase because of inaccurate or untimely inputs, assumptions, model adjustments, and outputs. Examples of common sources of liquidity risk in modeling include unsupported or unreasonable contingent funding assumptions, stress scenarios that do not consider all relevant legal or regulatory constraints, and inaccurate or unsupported behavioral assumptions. Interest rate risk. Interest rate risk is the risk to earnings or capital arising from movements in interest rates. The handbook notes that interest rate risk models depend on assumptions to accurately project cash flows from assets, liabilities, and off-balance sheet items. Common interest rate modeling issues include failing to assess potential exposures over a sufficiently wide range of interest rate movements, failing to modify or vary assumptions for products with embedded options to reflect individual rate scenarios, and failing to periodically assess the reasonableness and accuracy of assumptions. Price risk. Price risk is defined as the risk to current or projected financial condition and resilience arising from changes in the value of either trading portfolios or other obligations that are entered into as part of distributing risk. The handbook states that a bank incurs heightened price risk when trading instruments with prices that are hard to model, such as instruments that are illiquid or trade infrequently, newer instruments, and instruments with fair value that depends on accurately modeling human behavior. Risk management. The handbook emphasizes that each bank should identify, measure, monitor, and control risk by implementing an effective risk management system appropriate for the size and complexity of its operations. It notes that model risk should be managed like other types of risk, and that developing and maintaining strong governance, policies, and controls over the model risk management framework is fundamentally important to its effectiveness. The guidance advises that the extent and sophistication of a bank's governance function is expected to align with the extent and sophistication of model usage, and that materiality is an important consideration in model risk management. The handbook states that even with skilled modeling and robust validation, model risk cannot be eliminated, so other tools should be used to manage model risk effectively. These tools include establishing limits on model use, monitoring model performance, adjusting or revising models over time, and supplementing model results with other analysis and information. Governance. Sound governance includes board and management oversight, policies and procedures, a system of internal controls, internal audit, a model inventory, and documentation. The handbook introduces the concept of 3 lines of defense: 1 frontline units, business units, or functions that create risk; 2 independent risk management IRM, loan review, compliance officer, and Chief Credit Officer to assess risk independent of the units that create risk. And 3. Internal audit, which provides independent assurance. The guidance emphasizes the importance of effective challenge described as critical analysis by objective, informed parties who can identify model limitations and assumptions and produce appropriate changes. Effective challenge depends on a combination of incentives, competence, and influence. Board and management oversight. The handbook states that model risk governance is provided at the highest level by the board of directors and senior management when they establish a bank-wide approach to model risk management. The board is responsible for setting the tone at the top and overseeing management's role in fostering and maintaining a sound corporate culture. Senior management is responsible for day-to-day implementation of sound model risk management. Their duties include establishing adequate policies and procedures and ensuring compliance, assigning competent staff, overseeing model development and implementation, evaluating model results, ensuring effective challenge, reviewing validation and internal audit findings, and taking prompt remedial action when necessary. The handbook notes that sound governance encourages all key stakeholders to have effective communication, be transparent, and actively participate in model risk management, and that appropriate change management before implementing or when changing models and related technologies is an important component of model governance. Personnel. The guidance emphasizes that the bank should have competent and qualified personnel to execute and oversee model risk management, and that the skills and expertise of management and other personnel should be commensurate with the nature, extent, and complexity of the use of models. The handbook suggests that well-thought-out personnel development, recruiting, succession planning, and compensation processes promote successful hiring and retention of individuals with highly technical skills for model development and for model risk management across the 3 lines of defense. Model owners. Model owners are described as having ultimate accountability for model use and performance within the framework set by bank policies and procedures. They should ensure that models are properly developed, implemented, and used, and that models in use have undergone appropriate validation and approval processes. Model owners are generally responsible for implementing policies and standards, establishing and maintaining processes for identifying and measuring risks, maintaining internal controls, and maintaining documentation standards. Independent risk management staff. As the second line of defense, independent risk management (IRM) typically oversees business unit risk-taking and risk management activities and validates and challenges business unit testing and other first-line model risk management processes. IRM's responsibilities include implementing policies and standards, establishing processes for identifying and measuring risks, validating model inputs and outputs, confirming models are performing as intended, assessing issues for themes or patterns, and reporting to senior management and the board. Internal audit. As the third line of defense, internal audit reviews model governance and risk management and provide independent assurance to the board on the effectiveness of governance, risk management, and internal controls. The handbook states that internal audit should assess the overall effectiveness of the model risk management framework, including the framework's ability to address both types of model risk for individual models and in the aggregate, and evaluate whether model risk management is comprehensive, rigorous, and effective. Internal audit is typically responsible for verifying acceptable policies are in place, documenting and reporting findings, verifying records of model use and validation, assessing the accuracy and completeness of the model inventory, evaluating processes for establishing and monitoring limits, and evaluating the objectivity and competence of validation participants. Policies and procedures. The guidance states that, consistent with good business practices and existing supervisory expectations, banks should formalize model risk management activities with policies and the procedures to implement them. These policies should be commensurate with the bank's relative complexity, business activities, corporate culture, and overall organizational structure, and should be approved by the board or its delegates and reviewed annually. Policies and procedures regarding model risk management may include descriptions of governance and controls, definitions of models and model risk, acceptable practices for model development and implementation, roles and responsibilities, standards for model inventory, fair lending considerations, and controls for model development and use. Risk assessment. The handbook explains that assessing risk includes identifying and measuring the sources and magnitude of risks associated with model use. This is particularly important as a bank increases in size and complexity. The use of models becomes more widespread, or model results significantly influence decision-making. A sound model risk assessment process generally identifies risk both from individual models and models in the aggregate, identifies the model's capabilities and limitations, and measures the risks associated with model activities accurately and in a timely manner. Planning. The guidance states that effective governance for modeling begins with appropriate planning, and that a clear statement of purpose is typically the first step to developing models aligned with the intended use. Key planning considerations include identifying stakeholders, performing risk assessments, making informed decisions about implementing new models, understanding the purpose and limitations of models, integrating new technology with legacy systems, and ensuring appropriate controls for monitoring outputs that may be discriminatory. Model inventory. The handbook advises that banks should maintain a comprehensive set of information for models implemented for use, under development for implementation, or recently retired, and that a specific party should also be charged with maintaining a firm-wide inventory of all models. A comprehensive model inventory may include information such as model identifier, version, ownership, status, purpose, inputs and outputs, risks, validation activities, issues or limitations, and expected validity timeframe. Documentation. The guidance emphasizes that without adequate documentation, model risk assessment and management will be ineffective. Documentation should be sufficiently detailed so that parties unfamiliar with a model can understand how the model operates, its limitations, and its key assumptions. Documentation benefits developers, users, and risk management personnel, and should include information supporting decisions related to model selection, testing, governance, development, internal controls, and third-party risk management. Data management. The handbook states that to measure risk effectively, the data inputs for models should be reliable, and that there should be rigorous assessment of data quality and relevance and appropriate documentation. Sound data management includes providing reasonable and reconcilable support for qualitative factors, regularly analyzing the integrity and applicability of internal and external information sources and related controls, and appropriately handling data proxies and third-party data. Model development, implementation, and use. The guidance emphasizes that model risk management begins with robust model development, implementation, and use, and that the process should include disciplined and knowledgeable development and implementation processes that are consistent with the situation and goals of the model user and with bank policy. Model development and implementation. The handbook states that an effective development process begins with a clear statement of purpose to ensure that model development is aligned with the intended use. It should include documentation of the design, theory, and logic underlying the model, explanation of the model methodologies and processing components, and comparison with alternative theories and approaches. The development process should produce documented evidence in support of all model choices, including the overall theoretical construction, key assumptions, data, and specific mathematical calculations. For third-party models, banks should ensure that there are appropriate processes in place for selecting vendor models and require vendors to provide appropriate testing results that show their product works as expected. Testing. The guidance describes testing as an integral part of model development that includes checking the model's accuracy, demonstrating that the model is robust and stable, assessing potential limitations, and evaluating the model's behavior over a range of input values. Testing should be applied to actual circumstances under a variety of market conditions, including scenarios that are outside the range of ordinary expectations, and should encompass the variety of products or applications for which the model is intended. Ongoing development. The handbook notes that models are regularly adjusted to take into account new data or techniques, or because of deterioration in performance. It advises that material changes in model structure or technique, and all model redevelopment, should be subject to validation activities of appropriate range and rigor before implementation. Model use. The guidance states that model use provides additional opportunity to test whether a model is functioning effectively and to assess its performance over time as conditions and model applications change. Model users can provide valuable business insight during the development process and may question the methods or assumptions underlying the models. However, the handbook cautions that challenge from model users may be weak if the model does not materially affect their results, and that user challenges tend not to be comprehensive because they focus on aspects of models that have the most direct impact on the user's measured business performance or compensation. Model overlays and adjustments. The guidance defines model overlays as judgmental or qualitative adjustments to model inputs or outputs to compensate for model data or other known limitations. It advises that sound model risk management includes policies and processes regarding the review, approval, use, and backtesting of model overlays and adjustments. The handbook emphasizes that model overlays and adjustments should not be viewed as a solution that dissuades the bank from making improvements to the model, and that banks typically have a process to monitor and analyze overlays and adjustments over time and address underlying limitations and issues. Reporting. The guidance states that reports used for business decision-making play a critical role in model risk management and should be clear and comprehensible. Effective reporting enables senior management and the board to understand the bank's model risk. Reports presented to the board typically highlight performance measures, trends, and variances, rather than presenting the information as raw data, and may include measures on the volume of models considered high risk, models with temporary exemptions or provisional approvals, and underperforming models. Model validation. The handbook describes model validation as the set of processes and activities intended to verify that models are performing as expected, in line with their design objectives and business uses. It states that effective validation helps ensure that models are sound and also identifies potential limitations and assumptions and assesses their possible impact. The guidance emphasizes that all model components, including input, processing, and reporting, should be subject to validation, and that the rigor and sophistication of validation should be commensurate with a bank's overall use of models, the complexity and materiality of its models, and the size and complexity of the bank's operations. An effective validation framework should include 3 core elements. 1. Evaluation of conceptual soundness, including developmental evidence. 2. Ongoing monitoring, including process verification and benchmarking. 3. Outcomes analysis, including backtesting. Evaluation of conceptual soundness. The handbook describes this element as assessing the quality of the model design and construction, which involves review of documentation and empirical evidence supporting the methods used and variables selected for the model. Evaluation of conceptual soundness generally includes assessing whether the model achieves its intended purpose, comparing alternative theories and approaches, analyzing key assumptions and variables, evaluating data relevance, and conducting sensitivity analysis and stress testing. Ongoing monitoring. The guidance describes ongoing monitoring as confirming that the model is appropriately implemented and is being used and is performing as intended. It is essential to evaluate whether changes in products, exposures, activities, clients, or market conditions necessitate adjustment, redevelopment, or replacement of the model. Ongoing monitoring typically includes assessment of adherence to risk appetite and internal limits, analysis of overrides, sensitivity analysis, review of risk measurements, escalation processes, timely system updates, and process verification and benchmarking. Process verification. The handbook describes process verification as checking that all model components are functioning as designed. This includes verifying that internal and external data inputs continue to be accurate, complete, consistent with model purpose and design, and of the highest quality available. Process verification typically includes confirming inputs are processed as expected, reviewing reports derived from model outputs, and verifying that computer code implementing the model is subject to quality and change control procedures. Benchmarking. The guidance defines benchmarking as the comparison of a given model's inputs and outputs to estimates from alternative internal or external data or models. It notes that discrepancies between the model output and benchmarks should trigger investigation into the sources and degree of the differences. Outcomes analysis. The handbook describes outcomes analysis as a comparison of model outputs to corresponding actual outcomes, which helps to evaluate model performance by establishing expected ranges for those actual outcomes in relation to the intended objectives and assessing the reasons for observed variation between the two. Outcomes analysis approaches may vary depending on the characteristics and objectives of a model, and may include both quantitative and qualitative techniques. The guidance notes that models are regularly adjusted to take into account new data or techniques, or because of deterioration in performance, and that parallel outcomes analysis is an important test of such adjustments. Backtesting. The guidance defines backtesting as a form of outcomes analysis that involves the comparison of actual outcomes with model forecasts during a sample time period not used in model development, and at an observation frequency that matches the forecast horizon or performance window of the model. The handbook notes that analysis of the results of even high-quality and well-designed backtesting can pose challenges, and that models with long forecast horizons should be backtested, but given the amount of time it would take to accumulate the necessary data, that testing should be supplemented by evaluation over shorter periods. Third-party risk management. The guidance states that banks may benefit from third-party relationships by gaining operational efficiencies or improving the bank's competitive edge. However, a bank's use of third parties does not diminish the responsibility of the bank's board and senior management to ensure that the bank operates in a safe and sound manner. The handbook advises that third-party models should be incorporated into the bank's third-party risk management and model risk management processes, and that management should conduct appropriate due diligence on the third-party relationship and on the model itself. Third-party models and data. The guidance states that the widespread use of vendor and other third-party products, including data, parameter values, and complete models, poses unique challenges for validation and other model risk management activities because the modeling expertise is external to the user, and because some components are considered proprietary. When a bank uses a third-party model, it should obtain information from the third party, including developmental evidence, information about data used, testing results, documentation of limitations and assumptions, and implementation instructions. Engaging third parties for model risk management activities. The handbook notes that although model risk management is an internal process, a bank may decide to engage external resources to help execute certain activities related to the model risk management framework. These activities could include model validation and review, compliance functions, or other activities in support of internal audit. Banks should specify the activities to be conducted in a clearly written and agreed-upon scope of work, and designate an internal party to understand and evaluate the results of validation and risk control activities conducted by external resources. Its systems. The guidance states that banks should have appropriate risk management to maintain adequate its systems that result in appropriate and accurate model outputs. It emphasizes that sound model risk management depends on substantial investment in supporting systems to ensure data and reporting integrity, together with controls and testing. The handbook advises that the IT environment supporting the bank's models has appropriate controls before model implementation. This includes controls for the access, authentication, transmission, and storage of sensitive customer information, and appropriate security controls related to how the bank and any third parties access, transfer, share, and store information. This concludes our comprehensive summary with direct quotes from the OCC Handbook on Model Risk Management. If your credit union could use assistance with your exam, reach out to Mark Treichel on LinkedIn or at marktreichel.com. This is Samantha Shares, and we thank you for listening.